Hello and welcome to this Diwali special. Let's start by wishing all of our viewers a very, very happy Diwali. Happy festivities. It's been a phenomenal year for the market. A lot of wealth has been generated, not just over the last somewhat, but in the past couple of years as well. Today on this special, we are coming to you from the National Stock Exchange. There's plenty to talk about, plenty to reflect. And apart from discussing the market here and now, the current setup, we have a very special panel joining in because we today want to get into the minds of these stock pickers. They're no strangers to the street. They've been around. They have had a lot of success in some of the themes and some of the bets that they have gone with. So today, we want to know their secret. I'm Ravi and with me on the show is Manglam Mallu. Hi, Manglam.
Hi, and you're talking about us wanting to know their secret.
Oh, yes.
You know, the one who really want to know their secrets a lot more are the young.
Yep.
Why do I say that? Because the show is called the Young Guns of D Street. Now, there are three major reasons why. Young in the stock market is a relative term. These guys with an average experience of almost 20 years in the market, they look not like that, but
they're heavyweights,
they're heavyweights,
yes, exactly.
Serious heavyweights, and you'll know that with the assets under management and the kind of wealth that they've created for themselves and all the investors, etc. as well. But the more important part, and this is the analytical aspect of this, every time all of these people joined us on our channels, the kind of response that we got, we went through that, and the cohort that they resonated with the most were the young guns of D Street. So we have the young guns of D Street helping the young guns of D Street who are looking at this Diwali as an opportunity to perhaps, one, clean their houses, their portfolio, and also make a fair amount of wealth.
And one more thing, when you talk about young and youth, the one thing that you usually associate with that is energy, pace, and doing things quickly and perhaps ahead of the curve. That is what our five panelists have mastered. Picking themes early, being ahead of the curve, and riding it towards the road to riches. So we've got plenty to talk about. Stay glued to your screens because, we're just getting started. So, Manglam, let's start by introducing ladies first as always.
Ladies first as always. It's not about the age, it's about the attitude. And we have with us Rashi, Talwar, Bhatia. She joins us. She is the India head of Ashmore, manages the India long only fund, has over 20 years of experience in the market. A young gun that we have from D Street today. Joining us also is Roshi Jain, who is a senior fund manager at HDFC AMC. Total assets under management of the funds that she manages almost 1 lakh crores. But apart from wealth that she's managing and creating, what stood out was her academic, achievement as well. An IIM Ahmedabad graduate, also an All India rank holder in chartered accountancy, and a CFA charter holder. So a fair amount of education that went into what after which was a stellar, more than 19-year career in the equity markets.
Now let me come to the gentleman. Well, joining us is Ravi Dharamshi. He, of course, needs no introduction. He's no stranger to the markets. Been there, done that. It's sort of been in the family, but he has taken ValueQuest to newer levels. If you look at the performance of the PMS as well, on a steady state basis, we're talking 22, 23 kind of % returns over long periods of time, 5 years, 10 years, consistently beating the benchmark. He's very well known for some early bets in pharmaceuticals, in EMS, and we want to know a lot more about that as we go forward. So Ravi, welcome to the show. Right next to him is Amit Jeswani. Now, if you've been following us, especially on Closing Bell, you would know that here's a man who's almost picked every single stock that has skyrocketed over the last 12 months. So, hear this, 96% return on the fund in the last 1 year. The question is, how do you pick these winners and how do you ensure that, you pick winners that can last you through cycles as well? So that's what we'll discuss with Amit. Welcome to the show. And then, of course, we have Vikas, Khemani, the man who told us to stay, connected and have the faith during the worst of the COVID boom. I remember conversations with Vikas. He was saying, Atmanirbharta, China plus one, this is going to become so big. Right now, the market is falling like a knife, but you've got to have the conviction and go out and look at those bets. And we want to know more about that. He's been celebrated. Of course, his fund, Carnelian, has done really well over the last couple of years. And we will dive deeper into that thought process as we go forward. So, ladies and gentlemen, welcome to the show. It's great to have you here.
Thank you.
Well, let's start with Vikas first, largely because obviously he's no stranger to the ways the market works and the kind of wealth creation that he's done. He's been early on a lot of the themes that we're only now talking about. But Vikas, apart from all of that, you also believe in the long term. Mostly, always. Why do I say that? Because you're also a marathoner. You run so much, so it's in your mind. When you think of investments as a process, how would you define your investing process?
I think, as you rightly said, Mangalam, that first of all, I think wishing you and your viewers happy Diwali and New Year. As you rightly said, that investing is a long-term game. You are buying businesses from long-term perspective and thereby looking to create wealth. So hence, it's very important to have that mindset. And I believe that my biggest winners, my biggest success have come where I've stayed invested for 5, 10, 15 years. And that is where the compounding kicks in. And that, of course, the fact that since you're looking for long-term, you got to do your work really deep because, you are preparing yourself from a very long-term. You can't really do shallow work and then take that perspective, right? So quality and, quality of the management and quality of the business is very, very important before you sort of invest into it. But one, specific thing which has really, really worked for me over the years, if you want to make superior return, supernormal return, you have to always focus on rate of change or what is changing, which is not, something is changing, but the common narrative is something else. And if you are able to figure out something ahead of time, ahead of common narrative, then I think, it gives you a superior advantage, from an entry point of view, and then staying through the very long time as and when more and more people figure it out, right? So I think those are the things which has really, really worked for me. And, whether picking ICICI Bank in 2019, which has become 5x in last, sort of 5 years, when nobody was looking at. I remember when we bought, most people had 0 holding or 1% holding, and everybody's top holdings were something else. So but that really required a really deep perspective, different work. Or like Surbhi was mentioning that, I remember when we launched our manufacturing fund in October 2020.
Yeah.
We could see a lot from connecting to the ground, talking to the companies, saying that something is changing on the ground. But the common narrative was that India can never beat, China and Vietnam in manufacturing. Bangladesh is ahead of us. That was a common narrative. But what market and most people were missing was rate of change. What was changing? World is neither utopia nor dystopia, right? Somewhere in between. But what if we are able to find that rate of change, which is positive and accelerated, then you can really make supernormal return. The strategy which you were referring to, last 4 years have delivered 47% IRR, right? Which is, I think, beating the benchmark by 20%. Yeah. So I think, of course, you cannot compromise on the quality of the management, quality of the business, because that is where the biggest risk comes also from. But that's, I think, probably, if you ask me, most people do it and should be doing that. But I think real edge, according to me, lies in noticing, taking ahead of the curve, and that happens all the time. It's not like it happens once in a while. It happens at the company level, it happens at the industry level, and all the time things keep changing. So we focus a lot on figuring out those trends ahead of the curve, ahead of the time, and that requires a little deeper work.
So look for change. I think that's the first piece of advice that we've got from our panel, and look for change ahead of the curve. That's the first step to sort of looking at major wealth creation. And I'm so glad you mentioned ICICI Bank, because I'm going to come back to the story. We have a segment which is going to be on stock stories. That's what our viewers want to really hear. So I urge all of you to think of one example from your 20, 25-year investing career, one story to narrate. Amit, and your story is going to be trend. I'm going to ask you about that, but later in the stock segment. Right now, we want to really understand what drives you, this whole hunger for growth, because you buy growth businesses, and a lot of them have been on the consumer discretionary side, right? And I remember one conversation where you said, PE is fine, but we don't let PE hold us down. Elaborate on that point. What do you mean by that?
So, the first look, thank you so much, Surbhi and Mangalam, for getting me on this show, and happy Diwali to everyone. So we don't start by PE. That's the thing that I was trying to say. For us, the first most important thing is, what is the quality of business? Then we go to growth, because what will I do with a great quality business which is growing at 1%?
HUL in the last quarter? Sorry. Yeah. Okay. No names.
Like example, you spoke about HUL. Yeah. Since you're speaking about, but in FMCG criteria, we have stocks like Varun Beverages. While HUL was growing at 1%, Nestle probably this quarter was weak at 2%, but last 3 years been grown at 7-8%. All Godrej, Consumer, other players have grown at single-digit kind of growth. You had one player who was scaling, reinvesting capital at very high ROCs of 27%. That is Varun Beverages, and it was one of the top 4-5 stocks in our portfolio. That when everyone was struggling, this guy, because of Sting initially, was growing at 40-50%, and they also acquired the entire Indian market. So what I'm saying, in every industry, there is one guy who's scaling like there is no, like this quarter. If you see the entire QSR space, the numbers are horrible, a horror show. But you have on one side Zomato, who's scaling at 68%. You want to see, we see India in 71 industries. And in those 71 industries, like probably Trent, you spoke about Trent. This quarter Shoppers Stop grew at 7%. Last quarter Shoppers Stop growth was minus 4%. Last quarter when Shoppers Stop was minus 4, Trent was 58%. It's just telling you that who's executing. In every industry, there are players who are executing, and then players who are telling, "Arey, ye problem hai, that problem hai." Who wants to listen to their problems? You want to bet till the time they are doing well. Like we had DMart. To be honest, we had DMart from first day, first show. And we sold our DMart at 4,200 to get our Trent at 1,200. Because DMart slowed below 20%. And if you don't grow in India at 20%, then it's very tough to us, to be in our portfolio. So we are always chasing good quality companies. In fact, our portfolio beta is 0.8 against Nifty 50 since inception for 6 years. So it's not like we are taking high risk. There's a wrong notion that growth gives you risk. Bad execution gives you bigger risk. Then like higher P multiples.
So I've got the mantra: growth, growth, and growth, but with good quality.
Good quality.
With good quality.
Yeah, the best company in that sector. You don't buy the 10th best company, even if it's growing.
Market leadership,
so
good
the
quality.
two pillars that we've got, or as the young would call it, the quick hacks that we have right now. One of them is look for change, and secondly is go for growth and
with
quality, with high quality. Let's go across to Ravi then. Ravi, so many themes that you've identified. How do you identify these themes? I mean, what is the internal drivers that you put in place for you to be able to identify those themes, and what are you looking at right now?
And for the benefit of our viewers, I just want to sort of put the context there.
Yes.
Whether it's pharma, because you were one of the very early sort of persons, and you look at research in a big way. Whether it's pharma, whether it's EMS, or whether it's energy transition, these are some of the themes that Ravi has been very, very optimistic on. So exactly, going back to the question, how do you identify them?
Thank you, Surbhi. Thank you, Mangalam, for having me on the show, and happy Diwali to all. So I guess some variants of what Vikas and Amit just mentioned. Essentially, we are looking for, besides just looking for companies to invest in, first our starting point is looking for where to fish in the pond. I mean, identifying a pond that is growing, and then of course you want to catch the biggest fish. But where where in the pond you go to fish is what we look for. So our starting point is usually, which way the regulatory wind is blowing, which way the consumer behavior is shifting, where is the capital flowing, where is the technology evolving, where the cost curves are hitting the inflection points. Those are the leading indicators that we look for to understand which are the trends that are going to unfold over the next 10, 20, 30 years. However, those 10, 20, 30 years, I mean, it's good to say that I want to invest in this theme for 20 years, but it doesn't happen that way. You have to still break it down into a bite-sized 5-year investment horizon, because it's in that 5-year investment horizon that you have to make money. And a theme, for example, let's say energy transition, it's a large theme. And it comprises of 10 different subsectors within that. It's not like every sector is going to do well. You still need to do your sector picking within that, and then of course identify leaders within that. So our process is a combination of top-down and bottom-up approach, and we first start with the top-down and identifying the themes where the tailwinds are very, very strong, and then come to the picking stocks.
Right. Just to you, Roshi, you operate under the fund mechanism, where every fund that there is has its own objective, has its own risk-return ratios, has its own criteria, so to say. In that, what would you say is your individual style?
So thank you for having me, and let me start by wishing all your viewers a very joyous festive season. You're right. I think under the mutual fund umbrella, each fund has its own mandate. And I think one thing that perhaps is critical under the mutual fund umbrella is to stick to that mandate and not be swayed by what happens to be flavors of the season. Each post the SEBI recategorization of funds under different categories, I think that's perhaps one of the key learnings now imposed by the regulator that one needs to be true to label. And while that is a broad, one is of course sticking to the mandate, but I think the other important reason why mutual funds have also scaled up so significantly is also following an investment framework consistently. I think that perhaps less credit is given to mutual funds for that, but you will find that most mutual funds have an investment framework philosophy which is very well married with a risk management philosophy, which we perhaps tend to underestimate, and that's, I think, the key reason why we've seen this kind of scalability in the mutual fund space. Retail flows have come because of the trust, and that trust has been built because of following an investment framework, process, and a risk management framework.
You raised a very important point, Roshi, and I also track personal finance aside from markets as a whole, and I want to come back to that. How easy or difficult is it to maneuver a fund which is 65,000 crore rupees, right, or bigger funds which could be even bigger? So we'll come back to that, whether that's restrictive or how you sort of ensure the best outcomes. But before we take our first break, we want to know more about Rashi as well. Rashi is at Ashmore. So what's your personal investment philosophy and style, and how would you say that? Does it exactly mirror and replicate Ashmore? Differences, variants, similarities?
So thank you so much. Thank you guys for having me here. And slightly controversial or different from what we've heard from the rest of the panel.
That's great. Divergence of opinion makes the market.
The underlying fundamental that me and my team work with is that markets are not efficient. Right?
Okay.
And markets provide us opportunities where there's price dislocation or mispricing at various points of time. Markets swing from exuberance to pessimism, and we see that at all points of time. And at both ways, the pendulum swings to extremes. What we try to do at Ashmore India is to essentially find those opportunities in the market. So we run a market cap agnostic, benchmark agnostic, high conviction, bottom-up stock portfolio, where we're really looking for good businesses that are possibly going through a difficult time, maybe because something's happened in the company, something's happened in the sector, and there's a significant price dislocation. So the stock price is well below what we believe is the intrinsic value of the stock, giving us the opportunity to buy the stock. So if you look at my portfolio, we will typically not fall into either growth or value, which is why I said we're kind of different. But our contribution to risk return falls into what is squarely known as stock idiosyncratic or stock alpha. And that's what we do.
Right. This is absolutely beautiful because I can see a polar opposite to what Amit just said, which is why it's so good to have all of you on the same panel, because investors can figure out that the road to riches could be sort of varied, the paths could be multiple, but the end objective can still be significant gains.
Absolutely. So what we'll do is we'll just recap the quick 5 hacks that we got from all of them and take a short break, come back, continue our conversation. Vikas Khemani said look for change. Amit said look for growth. He said look where to look. That's most important. That's what Ravi said. Have an investment framework is what Roshi said, and then Rashi wrapped it up beautifully by saying look for price dislocations. Take a short break, come back, chew on that while we discuss a lot more on the other side.